Good morning, everyone. Appreciate two great presentations there before me. We've hopefully made it easy for you by all being called John, or variations of the word John. So when you're asking questions later, that should make it easier for us all to give an answer. My role at Ernst & Young, I run our oil and gas lead advisory business in EMEA, which is basically helping our clients to buy things, sell things, or find the money to pay for things. And in my 15 years in the industry, I've never worked on a transaction that's a UK buyer, a UK seller, and a UK target. So everything I've ever been involved in is cross-border. And I think if you look around the room today, you'll realise just how global the industry is that we operate in. In fact, last night it was brought home to me. We hosted a dinner for all of the speakers. And one of my colleagues proudly announced that England had won the football. And there were only about 3 people in the room who were actually excited about that. Some of our guests from Russia and from Holland seemed a little bit upset. We had to explain to a visitor from America that football actually meant soccer, and we weren't hosting an American football tournament that the US hadn't been invited to. So what I want to talk to you about this morning is some of the globalization strategies that the national oil companies are pursuing. We heard first from one of the IOCs. We've then just heard from Statoil, who are sort of in the middle, really, between an IOC and a national oil company. And I'm going to talk from the national oil company's perspective. Like Jay, I wanted to start with what's happening in the press. This is not a theoretical presentation. This is really reflecting what is already happening in the market and what we think is going to happen. These headlines, sorry, they're over there. These headlines are probably familiar to many of us operating in the oil and gas industry, but I suspect the people who you'd meet out on the street, certainly if you walk around Moscow or any other sort of capital city, probably wouldn't have seen these headlines. The headlines they'll be reading about, certainly in Europe, are economic crisis, political uncertainty, what's going to happen to the euro, maybe some mention of football. And I think as an oil and gas industry, we can't live in isolation from those wider news stories, and they really are impacting our industry. What they're doing, as John said, is creating challenges for some and opportunities for others. And those opportunities really are being created for national oil companies and also the majors, because the current capital market environment is making it very difficult for small and medium-sized companies to access finance, particularly those with large development requirements. But the major companies, the national oil companies, have got a very significant balance sheet advantage that they can exploit. That is creating significant investment opportunities. And it's no coincidence that one of the sort of current transactions that's getting a lot of headlines in the market, certainly here in the UK, relating to Cove, is a situation with a small independent. It needs at least $1 billion of capital, and there's a bidding competition between Shell and PTT, the national oil company of Thailand. And I expect we'll see more of that competition between the sort of two camps who have strong balance sheets to exploit. A few statistics for you. Over the last 4 years, national oil companies have completed roughly 50 international acquisitions. And by international, I mean outside of their home country every year. It's been fairly stable. But in the first quarter of this year, national oil companies completed 25 transactions. And up through the end of May this year, that figure was 40 transactions, deploying $16 billion of international investment. So almost at the level of 2011, and we're not quite halfway through 2012. And to put that into context, that accounts for nearly 30% of all transaction activity in upstream oil and gas in 2012. It's a significant part of the market. I think interestingly, and it's maybe not clear from this slide, but actually the majority of that capital that's been invested by national oil companies is directed towards the Americas, and particularly towards some of those unconventional plays which John was talking about and which we heard about yesterday. And there's probably three reasons for that. The first one is the capital story, which I was touching on. Many of the independent operators in the US are at $2 gas are struggling to deliver the cash flow in the short term, and they have short-term funders and short-term investors. Whereas national oil companies, you can take a long-term view, can really help to overcome that funding need. And it's no coincidence that most of the transactions are structured with the national oil company bringing the capital in exchange for equity. The second reason why the Americas are possible, and I think this is more a story on the oil side, certainly the Canadian oil sands in the short term, and maybe gas in the future, but those volumes will eventually find their way west and will eventually find their way into some of the domestic markets of the national oil companies. I do have, we were talking about this over dinner last night, I do think unlocking LNG out of the US and exporting it west into Asia is going to take many years to happen, and probably not in the volumes everyone anticipates. But certainly for oil and certainly for Canadian gas, I think that market opportunity is more imminent. And the third reason why these projects are attractive is the learning experience that goes with it. I think Jon talked about some of Statoil's learnings. One of the presenters yesterday talked about 51,000 unconventional wells that have been drilled in North America. That's more than the rest of the world put together and then multiplied by quite a big number. And if you look at China, which has got, you can debate this, but 20% of the world's shale gas resources, if you can learn from those 51,000 experiments, the speaker called it, that's a significant piece of knowledge to really develop that resource base back in the domestic market. And I think if China unlocks its shale gas potential, that is a real game changer for gas prices in the Asian market, and that's certainly a story that we're going to be watching over the coming years. I've talked about upstream transactions so far, and the reason I've done that is roughly 80% of the international investments by NOCs are in the upstream. But there are a number of NOCs who actually are blessed with significant upstream resources. Statoil in Norway, many of the companies in the Middle East, and some of the countries in Asia as well. And you might say, well, international strategies would be very different if you've already got the resources rather than if you need it. But I think if you look at some of the drivers behind internationalization and you come back to the host country, actually the drivers are not massively different. It is all about securing a position in the value chain for that country. Now, if you've got an upstream position at home, you may be securing your market downstream. If you've got a downstream market at home, you may be securing the upstream position. But it does all come back to that link into the value chain. And I think that's a very important mindset to have when you're thinking about national oil companies, about transactions. It's how does this impact the home country? It's not about your IRR. It's not about how much dollars you spend. It's about the impact on the home market. So there's quite a lot of consistency between what we see the importing NOCs trying to do and the exporting NOCs trying to do. That may be counterintuitive at first glance, but I think the more you reflect on that, probably the more it will resonate with you. We've talked a bit about why internationalise and the fact that this is a very current trend. I've produced a little bit of analysis on the how, and I must admit some of this was quite surprising. We looked at transactions since the start of 2011, and really the techniques that national oil companies have been using to build their international footprint. And what surprised me, certainly if you read the papers, you would expect that the vast majority of transactions involving national oil companies will be outright acquisitions. Yet since 2011, there are only 10 corporate acquisitions by national oil companies. And I think you can draw a number of lessons from that. Firstly, the importance of expertise that a partner can bring to national oil companies as they internationalise is a huge driver. So even in these transactions where there are outright acquisitions of companies, actually in the vast majority of cases, there's a big driver for the national oil company to retain the people and the expertise that come with that business. And I think the second thing you can take away, and this is probably important for any of you who invest in the stock market, the so-called China premium is probably something that is not going to be delivered in as many situations as maybe the market expects. You know, we have 130 oil and gas companies listed here in London. Everyone expects that they will grow to a size that the national oil company will then come and take them out at a significant premium. But I think that's going to be a lot less likely as a transaction outcome. What's more likely is the resource base will be attractive and a national oil company will find a way to create a partnership. And that's the central ground. I'm going to talk in a little more detail about partnerships and joint ventures and some of the challenges national oil companies face. But the last column I think is also interesting. This is a very, very small percentage of the number of transactions. In fact, our research team really struggled to find an example to put into that box. In the copy of the slides I've got, that box was blank. So credit to our researchers for actually finding an example. But I think in an industry where you have national oil companies who are looking to cement their downstream position and other national oil companies who have a downstream market but are looking to secure upstream supply, that national oil company collaboration and partnership, structured potentially as some kind of swap transaction, I think will become much more common. If I was sat as an IOC, if I was working for Chevron, this would be something I would really be worrying about, because these kind of transactions could cut out the IOCs. You know, you could quite easily see Saudi Arabia and China doing some kind of transaction where China accesses reserves and Saudi Arabia accesses the downstream market. And I think those sort of arrangements will become more common. I've got a financial background, as have most of the 9,000 people in our oil and gas team. So I haven't got any seismic slides. They're all wiggly lines to me. But I wanted to talk about some of the challenges that national oil companies face when they're going abroad. And I actually don't think the technical subsurface is a challenge. Bear in mind that the subsurface conditions were established hundreds of millions of years ago. Most country boundaries were established less than 100 years ago. So the subsurface doesn't know if it's sat beneath Texas or France or China or Kenya. Yes, it might be different in different parts of the world, but actually the challenges are really all above surface in terms of a globalization strategy. Most of the conditions are really driven by how the country which a national oil company might be investing in differs from the host country. And then I think some of the other challenges are really driven by taking a business that moves from operating in one geography and broadening it into multiple geographies. And that's not a challenge that's unique to national oil companies. That's a challenge that's unique to any company that's looking to grow and looking to expand its global business. I know one of the later presentations is going to talk about joint ventures and structuring joint ventures, so I'm not going to talk at length about this topic. I want to leave just two messages with you on joint ventures. The first one is the importance of planning. I've set out there 4 different stages, if you like, of a successful joint venture. But the only stage where you, as a national oil company looking to create a partnership, actually control your own destiny is in that first stage, the preparation stage. In all of the subsequent stages, you are working in partnership with your local partners, and their objectives may not be the same as yours. In fact, they're extremely unlikely to be the same as yours. So this preparation phase is hugely important, and it's the area where things go wrong. And you don't know that at the time. but you usually find that out at the end. And you usually find that out when you come to exit, because at the point of exit, your objectives and your partner's objectives, by definition, are different. And if you've not thought of that at the time when you have a control of your own destiny, or you're at least sort of working together with your partner to structure the joint venture, it's too late. So my message on this slide would be, please don't underemphasize the importance of planning. And even though we all hope that we get married for life, recognize that we often get divorced, and think about that at the beginning. The second message that I want to leave on joint ventures, and it comes back to the theme I was talking about on finance. And many of you in this room are blessed with very strong financial sponsors, being host governments, and being host governments that are not in the EU, so potentially in stronger financial positions than we see here in Europe. But your partner might not be in that position. And project finance is an area that is very unfamiliar to many national oil companies, but it is usually something that the international partners will be very enthusiastic for. And by definition, project finance is something that requires the whole project to have the same view. So you can't have a different view to your partner on this. You've all got to go for project finance, or none of you can be successful. And this is an area that not only drives very different structures, it also drives significant reporting and governance requirements that might be unfamiliar. So the second message I wanted to leave on joint ventures was, you've got to think about the financial position of your partner. Usually that's created an opportunity for you, but it could well also have created a challenge for them that you need to manage through the project finance process. I don't like to end presentations on a negative slide, so this is my next to last slide, and this is our some thoughts really on where we've seen international strategies come unstuck. And we've tried to graph it on the risk of losing money and the risk of damage to your reputation. And I would argue that the risk of damage to reputation is more important for several reasons. Firstly, you are representing your country. So any reputational consideration reflects back onto your home government and their standing in the international community. And secondly, your reputation in this industry is really what gives you your license to operate. It's no different to the IOCs. We saw both Jay and Jon present slides on safety. You know, that goes to their company's reputation, and without that reputation for health and safety, they're not going to be welcome in future projects. And the same will apply to national oil companies. So what we see that the drivers around reputation tend to relate specifically to that project and the operation of that project. And this is where it's important to have gone through that thinking about how operating in a new country is different to how one might operate in your home country. The chances of losing money are actually driven at a more strategic level. They're not specific necessarily to the project. If you've got the wrong strategy and you've gone in the wrong direction, you could lose a lot of money. But if you've done it in an environmentally sensitive way and you've operated with good standards of health and safety, your reputation will probably remain intact. So success is a balance of how you operate and manage the projects, but also coming back to that point about planning, how you set your vision and deliver on that strategy. So I want to end on a more positive slide, which is actually what do we think helps one succeed in implementing an international strategy. The first 2 points relate to planning. It's I think all of our presenters so far this morning have had slides which have talked about what happens in 2020, 2030 and beyond. It is not just a strategy for the next 2, 3, 4 years. It's a long-term vision. But it's important to get off in the right direction. So please, aim to deliver against those initial promises, because that will help to set the tone for the future. So the first 4 points there really are about planning and communication. It's only the second 4 points really which are actually about operation. And the first one is doing the right transaction, finding the right partner. If you remember, I sort of 3 or 4 slides ago talked about partnership, and that's the way the majority of transactions are structured. So you can set, by picking the right partner, you've really sort of set yourself in the right direction. I think it's important that whatever you do, your first international transaction may be a step on a journey, but it's got to be scalable. These are significant step changes for NOCs to go and operate internationally. So do it in a way that one can learn from it. I think we heard about Statoil saying they'll start with a non-operated position, they'll move towards operating, they'll add to acreage. That is a scalable story, and I think that is hugely important. You don't have to go big on the first transaction, but you do have to have the potential to get to somewhere meaningful as part of your international strategy. Recognise that the local regime might be different to your domestic regime. And finally, as a firm of financial advisors and professional service providers, I couldn't leave a presentation without touching on systems and processes. And I think that is hugely important as you try and integrate these international businesses. I recognise I've skirted over a lot of content there in quite a short period of time. What we have done is expanded on this presentation into a report, and that's available at the Ernst & Young stand next door. And if anyone's got any questions, my contact details are there. Thank you.